Chapter 8. Keeping Your Perspective Right. As an investor, you should be looking at your investments and potential investments from the correct angle. Usually, the correct perspective is simpler and more straightforward. Calculate the fair value through discounted cash flow method. If the price is significantly below this amount, buy the stock. And if the price is considerably above it, sell your investments. Fair values of most commonly held stocks are routinely done by the analyst community and widely available for free, either on the internet or on your broker website. However, I would advise taking an average of analysts' fair value with not a grain, but with a whole ton of salt. You can start with a fair value calculated by analysts as a starting point. However, you will always be better off by recalculating your own fair value. Focus on business. It is essential to learn as much as you can about the business of the company. Learn about the customers. Learn about the supply chain. Learn about margins. Learn about each and everything you can think about. Assume you have enough money to buy the whole company and you are about to make an offer. Think about what you would do in this situation and do the same even if you are buying only a couple of hundred stocks. If you are buying a stock only because you want to sell it at a higher price in a few weeks, you are probably on the wrong track. Remember, in each transaction, there are two parties, buyer and seller. Only one can be right, so statistically, an average trader can be right 50% of the time. It will be a wash for traders as a whole. Sure, some people will beat the odds, but the majority of traders will be on the losing side. You cannot fight with mathematics. As a group, traders' net return will always be lower than investors by the amount of transaction cost, plus research expenses. Transactions or activities of buying and selling have no impact on the actual business of the company. The business pie is not getting bigger by somebody selling its stock to somebody else, but the total return will be smaller for sure by the transaction cost. Keep doing it enough times, and eventually, all of your capital will be in the pockets of brokers. Invest in a business, not in the price of a stock. Buy a stock for business reasons and hold on to it until those reasons stay valid. For example, if you buy a company because they make the best processor in the world, hold on to that stock until this reason remains valid, no matter what happens with the price. Stay away from price action. Looking at your stock's prices all day long serves no good and is a complete waste of time. You will be better off checking prices occasionally and investing your time in learning about the business. Short-term price action looks like an opportunity to make money, but generally it is not. Refrain from checking the price and talking about it with your fellow investors. Instead, talk about the business of that company. Price is not always right. Price is not a good indication of the fair value of a business. The market works like a pendulum and stays on fair value for very little time. Stocks are generally overvalued or undervalued for the most part. Price is an agreement between two parties who have opposite views of the same stock. Only the future can tell who was right and who was wrong. If the price is wrong for at least one of the two people doing the transaction, how can it be perfectly right for you? Look at the business from different angles. As an investor, you should be looking at the business of potential investment critically from different vantage points. For example, the perspective of business owners can be very different from the perspective of their customers. The way a competitor looks at the company is different from how a supplier of the company looks at the business. Try to analyze potential investment from the eyes of various stakeholders. A business could be very different in stressed economic times than in an economic boom. For example, a leisure business like a cruise provider is the best investment at the time of prosperity. But when a brutal recession hits, its earnings will be the first to be cut. You need to understand how your company will perform in different economic cycles. Another example of a different vantage point is the regulatory environment. Some businesses do very well in the specific regulatory environment, but the company may turn southward when regulations change. For example, a corporation of genetically modified seeds can be flourishing if there are no restrictions on selling GMO seeds. However, if regulators decide to ban GMO seeds altogether, this business cannot survive no matter how good the balance sheet is or how far they are in their research. Count all the assets. More often, the most significant asset is not on the books. When you start analyzing a business, start with counting all of its assets. it is not as easy as looking at the assets side of its balance sheet. More often, the biggest asset of any business will not be on the books. For example, the general public's trust is the biggest asset of a financial business, like banks or insurance companies. They are the custodian of public money. As soon as they lose their trust, the public will be lining up outside the door to claim their money. And in no time, there will be no business. You don't find public trust in any of the bank's balance sheets. Assets are generally recorded on a historical cost basis. It means at the purchase price. Over time, depreciation and amortization are recorded. Book value gets smaller and smaller. After a few years, book value goes to zero, regardless of that asset's future economic benefits. For example, a company buys a building in a major metropolitan, and over the years, the building depreciates in books and has zero book value. Despite its zero book value, the building may have a real economic value of millions of dollars. As an investor, it is your job to count for all these assets. Accounting rules make counting assets even harder. For example, research cannot be counted as an asset under accounting rules. However, when a company buys another company, the same research dollars appear on the balance sheet as goodwill. The same applies to marketing dollars spent on brand recognition. When a company buys another brand, most of the dollars paid on brand recognition will appear on the two companies' combined balance sheet as goodwill. In this world of artificial intelligence and machine learning, data is one of the most significant assets a company can acquire. Data can be used, rented, or sold for profit, like any other asset, but it cannot be recorded as an asset. Humans are doubling recorded data every couple of years, and unlike any other asset, new data is not devaluing old data. It enhances the overall value. The concept is hard to comprehend because older models are generally less useful when a new machine is bought. However, in big data, old data becomes part of all recorded data and becomes more valuable. The other side of the coin is overvalued assets. More often than not, it is the goodwill that is overvalued. CEOs are human like you and me, and they tend to make impulsive buying decisions too. The only difference is the total amount. When a company buys another business, it records all of the acquired company's assets and liabilities on its books. The difference between the purchase price and net assets is recorded as goodwill. It is a balancing number. Nobody calculates it. It can be undervalued or overvalued. More often, it is overvalued. Let me give you an interesting example. Google bought YouTube for $1.65 billion. At the time of purchase, everybody said Google paid way too much for YouTube. However, after many years and with the phenomenal success of YouTube, most will agree that it was the best purchase Google ever made. I disagree with this opinion. I still believe Google paid way too much for YouTube. It was the enormous resources of Google that made the YouTube we know now. If Google had bought any other video sharing website, that website would have been the #1 website of today's world. YouTube was indeed the #1 video sharing website at the time. Still, it would have been impossible for YouTube to be as successful as it is now without mighty dollars poured from Google, given the high cost of the video sharing business. Count all the liabilities. Look for promises and guarantees. A vigilant investor needs to count all the company's liabilities, whether those liabilities appear on the balance sheet or not. Counting liabilities is more straightforward than measuring assets, as you will find some sort of indication on financial statements. However, correct estimation of future liabilities is as tricky as assets. For example, an oil extraction company will indicate potential environmental costs, but an accurate estimate is not easy. Another example is guarantees provided to associated companies or funding needed for employees' retirement plans. Look for indications of potential liabilities in financial statements disclosures and make a base case, best case, and worst case analysis of each of the significant liability classes. You will generally find 2 or 3 major categories of liabilities in one company where this type of research will be needed. Count revenue, one by one. Most of the time, any large company has multiple streams of revenue, and it is crucial to analyze each of these streams individually. The most important part is establishing a ceiling of each revenue class and how fast revenue is reaching there. For example, if a company makes pasta, Its maximum potential is the total annual consumption of pasta by the total population. If this company already has most of the market share, it will be hard to grow further. The second step is to look at the margins. A healthy gross and operating margin is a must, and margins should be improving over time. In some cases, decreasing margins can be acceptable if the company is trying to increase its market share. Margin needs to be analyzed compared to peer groups, as each industry has its average margins. You cannot expect a software business's profit margins from the steel industry. It would be silly. A high margin doesn't necessarily mean a profitable business. It is relative to the industry. If a company has unusually high margins, it could be a bad thing. You need to see the whole picture. What if a company is losing market share just to increase its total profit? What if the CEO's bonus is linked to net profit only? Another critical aspect to consider is the distribution channel and revenue sharing with distributors. The vehicle manufacturing industry is an excellent example of where cars are sold through a network of dealers. Another example is consumer goods like shampoos and chocolates. These products are sold to customers through multi-layered distribution channels. Count expenses, variable and fixed. Counting expenses is as critical as counting revenues. The first step you need to undertake is to divide the costs among two categories, fixed and variable. Fixed expenses do not increase or decrease with the change in revenues. For example, rent for a steel manufacturing plant's office space. It doesn't change when the company doubles its manufacturing. Generally, all operating expenses are in this fixed expenses category. Variable expenses go up and down with the change in revenue. For example, the commission of sales staff. It goes up when sales are high and goes down when sales are down. Generally, all expenses listed above the gross profit line in a company's income statement are variable expenses. This is an easy way to categorize these expenses, but a close inspection may be needed. When counting expenses, analysis of the supply chain is critical. For large companies, this information is available, but it could be tricky to find a list of major suppliers for smaller companies. However, through careful reading of management reports, you will find out the name and locations of major suppliers. Another essential aspect to consider is the type of expense that is common in a particular industry. For example, some industries rely on heavy advertisements, and some rely on heavy R&D. Some industries pay heavy sales commissions, and some pay hefty distribution expenses. It depends upon industry norms and practices. Calculate growth ceilings. When analyzing a company with a high growth rate, it is imperative to know where the growth ceiling is. High percentage growth cannot be sustained forever. If a company's current revenue is $1 billion with a growth rate of 60%, in 20 years with the same growth rate, revenue will be over $12 trillion. When you buy a high growth rate company on high PE multiple, ask this critical question. How big is the total market, and how soon will the growth slow down? Sometimes, a company is a pioneer in a niche market and keeps doubling its revenue each year. However, other companies will promptly enter the field. Growth will be substantially lower than it used to be. For example, total advertising dollars is the ceiling of the entire advertising industry's revenue and will grow with the regular GDP growth rate. These dollars are divided among print media, television, radio, internet, and social media. No matter how fast these dollars are shifting from print media and traditional television to the internet and social media, it will slow down after a few years because total dollars are not increasing by a 50% plus rate each year. Take a look at the growth rates of a company's initial years and try to link PE multiples that you are about to pay for that growth. Many people will tell you that PE doesn't matter as long as the company is growing, but it is not always the case. Many times, PE multiples rise to unbelievable numbers that no amount of growth can justify. Shares buyback is not always a good indication. Lately, shares buyback programs have become popular, and many investors suggest that if a company is buying back its shares, it must be a good buy. However, it is not always the case. Companies buy back their shares for multiple reasons. Sometimes to accommodate employee share ownership plans, sometimes for tax purposes, and sometimes just to give share prices a boost. Theoretically speaking, share buyback is an excellent tax and financial strategy. Companies should buy their shares if market prices are stressed and are significantly below actual book value. However, this tool can be used for some not-so-good reasons. For example, if management's compensation plan is linked to share prices, it is their best interest to buy back the shares instead of giving dividends to shareholders. Sometimes, companies use share buyback to boost the market prices, even though they know that market prices are above their economic value. As a prudent investor, you should not automatically assume that shares buyback in large quantities is a good signal. Take a look at the competitive advantage, the barrier to entry. Competition is a sin. John D. Rockefeller. Take a look at the competition. If the business is excellent, the competitors must be on their way. A profitable and long-lasting business must have a competitive advantage of some type. Warren Buffett calls it a moat around the business castle. It should not be easy for other companies to enter the business and take away the market share. Suppose a rich margin business is easy to enter. In that case, it will be crowded to the level where all advantages of high margin will be eliminated. For example, the business of home building. There is no barrier to entry in this business. Anybody with some capital can start housing projects. If a business has some moat, it can dictate the prices and earn elevated margins for an extended period. Surprisingly simple companies enjoy better competitive advantages than high-flying technology stocks. Chapter takeaways. When analyzing a business, keep things simple. Buy the business, not the price. Stay away from daily price action. Always analyze the business from different angles. Perspectives of customers, suppliers, or competitors can be very different than the management. More often than not, the most significant asset may not be on the balance sheet. Always calculate the growth ceiling of each revenue stream. The share buyback is not always a good indicator. Look deeper.